Alrighty, guys, welcome to our second session tonight. We're going to be covering all things life insurance. This is the second day of our course. We're going to speed run through this class to get you licensed within the next 2 weeks. So we welcome you on here for you to take notes, ask questions. This training is meant to be engaging and to make sure that we are ready to go. So again, this is chapter 2 of Ucanpass. This state course right here is meant for the state of Florida, but most of the concepts are universal. And we're actually going to talk about them type of policies tonight. So all the ladies that are on with us this evening, just make sure that you are in a good place where you can take notes, listen, learn, and ask questions. A couple of the things that we're going to touch bases on, terminology that we need to know. Attained age. What does attained age mean? That is the time where a person is getting their policy either issued or renewed. You're going to hear that word attained age at a very long, around the a lot. Cash value is the policy savings element or living benefit to a policy. Face amounts, we talked about this yesterday. Face amount is another word for death benefit, the amount of money that will be benefit from a life insurance policy. The word deferred is withheld or postponed until a specific date or event in the future. You're going to hear the word deferred, meaning that's going to come around talking about how soon you can start receiving money or deferring, withdrawing money from an account. The word endow is it's going to be talking about the cash value of a whole life policy that has reached a contractual face amount. When you see the word endow, write the age 100. At 100, the policy will endow, aka mature. Next one, level premium. This is the premium that does not change, but will stay consistent throughout the life of the policy. Level premium. Next one is liquidation of an estate. That is when you're converting a person's net worth into cash flow. I love the word cash flow. You guys see this shirt? I am Miguel Camargo, Project 50. Come on, it's a shameless plug. Got a huge campaign running right now for that. Non-forfeiture options. This is the benefits in a life insurance policy that a policy owner cannot lose money in their policy due to surrendering or elapsing the policy. So non-forfeiture values, we're going to go into really good detail on that. Policy maturity. We're going to talk about that. Again, write the word age 100 next to policy maturity. Policy maturity and endow, they don't go together, but they can sometimes get confused. So in policies, at age 100 is when a policy matures. And when a policy matures, that is when the actual policy owner would receive the death benefit. You know, life insurance is generally not for the policy owner. It is meant for the beneficiaries. But at age 100 in certain policies, a person can receive all their money. And for testing purposes, it is at age 100. Securities. Those are financial instruments that may be trade or value. Example, stocks, bonds. We're not going to talk about a lot of securities in this chapter, but it's just right there for us. Okay. So this is the real part we need to know. The first type of insurance is called term insurance. When you see the word term insurance, I want you to write temporary next to that. Temporary protection. And next to that, I want you to write pure death benefit, pure death protection. Term insurance is temporary protection, also known as pure death benefit. The easy thing about term insurance, you buy it for a certain period of time. Once that period of time is over, the policy will expire. Now, the good thing about term insurance is that since it's just insurance, you can generally get a high amount of coverage for a low amount of money. Sometimes there's a maximum age that you can have coverage up to. Not all insurance companies sell the all term policies that are created equal. So there are certain type of terms that are better than others. So let's go through here. Term insurance does not have cash value to it. I need you to make sure that you know that. Term insurance does not have any type of cash value attached to it. I have clients ask me, well, hey, does my policy or does this kind of policy allow me to borrow money from it? If they have term, absolutely not. Okay. And term insurance will only pay a death benefit in the period of time that they are covered for. You can have term policies from 10, 15, 20, 25, 30, even up to 35-year term policies in place, depending on what company you're with. Any questions on term insurance? Nope, we're good. All right. So the other type of policy. So, okay, forgive me. We're going to talk about the types of coverage that's available. Types of term policies. There's level term. There's increasing term. And there's decreasing term. Let's cover the first one. Level term insurance. All that means is the premium is leveled throughout the entire period of time. And the death benefit is leveled the entire time. So if you get a policy at age 20 years old and you have a 20-year term, that death benefit and the premium you're paying will stay the same for the next 20 years. So know this, level term refers to the death benefit that does not change. I said it refers to the premium. Generally, your premium is not going to increase during a level term policy. The next type of policy, I want you to write this down. Annual renewable term. Next to that, I want you to write the word ART, A-R-T. Annual renewable term is the purest form of insurance. So it's generally the cheapest type of insurance you can get. The only the only catch with annual renewable term is that the premium goes up every year, but you don't have to prove any insurability, okay? So with most term policies, depending on the company you're writing with, anytime at the end of the term, that client will have to requalify medically. So annual renewable term, if you get it at age 20, it's going to go up by a couple of dollars, couple cents at 21, 24, 25, 26. It's only until you get to your older ages of like 70, 80, 90, where it becomes drastically expensive. You know, one of the ways that I learned about annual renewable term insurance is that it's like Uncle Murphy. You know, you ever heard of Murphy's Law? Anything that can go wrong will go wrong. Well, if you have annual renewable term insurance, it's cheap when you're younger, but when you get older, you're like, man, this thing's too expensive. I'm going to cancel it. And guess what happens right when you cancel it? That person passes away. You're like, man, I should have kept that thing. So annual renewable term is probably not the best product for someone that's older, but it is good while you're young. So just getting key points. The policy renews every year. Anytime your policy renews, your premium is going to go up, but there's no proof of insurability. There's no medical questions. It is also known as level term insurance. Easy test question for you. If you say, well, on the question, it'll ask you which of the following are level term, and you're thinking, well, all these other ones are not level. Annual renewable is. The next one is decreasing term. So right next to decreasing term, I want you to write the word mortgage. Mortgage protection. So what do we know about a mortgage? If you get a 30-year mortgage, hopefully by year 29, You don't owe as much as you owed on year one, right? So mortgage protection, term insurance, is that the premium is going to stay the same over the whole period of time, but the death benefit is going to decrease, just like if you were to have a mortgage. So let's just say you had a 10-year decreasing term policy. The premium is, let's call it $100. Your face amount by year 10 is not going to be 100 grand. It's going to be, let's call it 20,000, but you're still paying the same $100 a month. And the only reason you're getting this is to cover any debt that you might owe. So again, just to summarize, the premium will stay the same. The death benefit will decrease every year until eventually the death benefit hits zero. The next type of insurance is called return of premium. Return of premium insurance, it can be written as its own policy, but sometimes it's added on as a rider. And I'll cover what a rider means here in a little bit. But return of premium is generally an increasing term policy. And the way this works is, let's just say you have a 30-year term policy and you're paying $500 a year. You're going to keep paying that $500 a year for the next 30 years. And if you live to age 30, they say, congratulations, you lived. Here's all your premiums back. How exciting does that sound when you hear that? That sounds good, right? The difference is sometimes the cost is as much as 25 to 50% more of what you would have bought with just a level term policy. So the catch of it is I'm willing to pay a little bit more now in the hopes of I might get something back in the later, or would you be better off buying a cheaper term policy and then investing the difference into a financial vehicle? So when you outlive that 30-year term policy, you have more money in your savings vehicle versus if you would have just put into an insurance policy. Does that make sense, ladies? Good. That's all you need to know about return of premium, guys. Let's talk about special features. So most term insurance policies are renewable, convertible. Renewable means at the end of the 20 years or 30 years, you can renew the policy. Convertible means, hey, listen, after 30 years, I've had this term policy. I want to convert it to a permanent policy. We're gonna talk about permanent policies here in just a second. But when you renew a policy, depending on the company, you can renew it without any evidence of insurability. So you don't have to go through any medical questions. They say, congratulations, you want to renew your policy after 10 years? We'll renew it for you. Only difference is, since you're now 10 years older, you would now be charged at whatever age you were. So in this example, you got a 10-year term at 35. You renew it at 45. You're now going to be paying the age of a 45-year-old versus 35. Convertibility options. Let's just say you had a 10-year term and you got to 45 and you said, hey, listen, I don't want a term policy. I want to convert this to something more permanent, more long-term. Well, that would be known as permanent insurance. Now, I want you to go to a whole new page, guys. Everything I told you about term, I want you to keep that separate from whole life. Start a whole new page, please. Now, this is something called traditional life insurance products, okay? Permanent policies, meaning the policy will stay in play until you die or until you reach 100 years old. So you remember that word we talked about, maturity? That's when that comes into play. If someone lives until 100 years old, the policy matures, and then that death benefit that would have been paid to the beneficiary is actually given to the person that's still living. Insurance company says, congratulations, you've lived to 100, you daggum deserve some money. Just now you're old, crinkled up, you're wrinkly, and well, I don't know what kind of balling out you doing now. Now that you're old, right? Now let's talk about this, okay? Whole life policies provide lifetime protection and a savings vehicle, okay? So whole life insurance, it's life insurance plus cash value. I want you to write that down. Life insurance plus cash value. I'm going to simplify whole life insurance to you. Sometimes this can get very complicated, but I'm going to spend a few minutes helping you understand the skeleton of life insurance. So when you have a whole life policy, you have life insurance and it's being bundled with a savings vehicle. So you have a portion of your premiums going towards life insurance and a portion of your premiums getting put into a savings vehicle that you have access to, okay? Now, I want you to write this down, whole life insurance. I'm going to give you 3 things you need to know. Every whole life policy has a death benefit, cash value, and premium. Those are the 3 things you need to know. It has a premium attached to it, whether that's leveled or it goes up. It has a death benefit attached to it, and it has a cash value attached to it. The 3 things coincide with each other, which is going to be based off how you want the policy structured. Now, we're going to talk about living benefits. There are certain policies that are sold that you can use a portion of the cash value to borrow from. We live in an era today where people are bombarded with social media ads of people talking about living benefits and whole life policies that you can borrow your money, and that you can use this money. So let me give it to you right here. I'm going to spend a couple minutes on this, but it's very important. Whole life insurance. When you put money into a life insurance policy, your cash value is going to grow. The cash value typically will remain 0 for 3 years. So make sure you write that down. The cash value will generally remain 0 for the first 3 years, depending on the policy, depending on how much you put into it. We call those non-forfeiture options. That word right here that I'm highlighting, or I'm trying to highlight, non-forfeiture values. And whole life policies, cash value grows tax deferred. So I want you to write that down. Cash value grows tax deferred. If you don't know what that means right now, that's okay. I just want you to write it down. Cash value grows tax deferred. All right, so know this, whole life insurance, lifetime protection accumulates cash value. So I want y'all to, I'm gonna go very fast here, but if you understand what I gave you, these things are gonna make sense rather easily, okay? So ordinary life insurance is the same thing as traditional life insurance. So whole life, traditional whole life, ordinary whole life, and straight life are all the exact same thing. So you can write that down and together, like whole life, or traditional whole life, straight life, ordinary whole life, the exact same thing when it comes to this exam. Now, what did I explain to you about whole life insurance? It has cash value, it matures at 100, and it has a death benefit, right? Those are the skeletons. Now, straight life, when you see the word straight, I want you to write the word level to it next to it. Straight and level both describe what's going to happen to the death benefit and the premiums. Level is just another word for straight, which is describing the premium and the face value. So if you buy a straight policy, it's going to stay the same price the entire time you keep it. Level term insurance, it's going to stay the same price the entire time you keep it. That's all we need to know about whole life insurance or straight life. Let's talk about limited pay life. Okay. The way limited pay life works is this. You pay for a period of time, and after you're done paying on it during the contract levels, you're done paying on it and you can reap the benefits of it. So limited pay. There's two types of limited pay. I want you to write these levels down. There's life, L-I-F-E, at 65. So life at 65. And then there is 20-year pay. That's 20-year pay life, 20-year pay life. And there is single premium life. So let me just repeat it. We got 20-year pay life, life at 65, single premium life. And all you're doing is you're taking all the premiums and paying them up front. So guess what we know? If you're going to pay a lot more money up front, the policy is a lot more expensive. So let's cover this. If you were to get a 20 pay life, if you get it at 20 years old, you're only going to pay for 20 years, and then it's paid up. That's a simple definition. Pay for 20 years, it's paid up. The next one was the next one was life at 65. Well, if you're 20 years old and you get a life at 65, that means you're going to pay for 45 years. So you're going to take 80 years of premiums and put it into 45 years. And whatever that premium would be, you're good to go from there. The other one was single premium. Next to single premium, I want you to write the word lump sum. So imagine single premium, you're paying the whole policy up in one payment. We already know it's a lot of money, right? So you're going to pay one payment and then you're done. So remember how I told you most life insurance, most whole life policies do not accumulate money for the first 3 years? This is the only whole life policy that cash value generates immediately. So under single premium, I need you to write the word lump sum, and cash value grows immediately. And that's all you need to know about single premium. You pay one big payment up front. The cash value will continue to grow over the period of time based off of the vehicle that it's saving and invested in, but the cash value grows immediately. Do we have any questions on that? No? Okay, cool. So let's get into the more fancier policies. Okay. Understand this. Everything we've covered, the skeleton of whole life insurance, okay? There's a premium, there's cash value, it matures at 100. We're going to keep that, okay? And now we're just going to add a couple extra little customizations in the life insurance policy. The first one is going to be called adjustable life. Adjustable life was developed to have the best of both worlds between term insurance and permanent coverage. So somebody says, I don't want complete only term. I want whole life insurance so I can keep my policy in place for a long time, right? So I want you to write this down. In adjustable life, you as the insured, you get to choose two. The insurance company chooses one option. So there's three options in this policy. You choose two, insurance company chooses one. Okay. How many do you get to choose? 2. And the insurance company gets to choose 1. So what do you get to choose? The insured can say, hey, listen, I want to increase or decrease my payments. So you get to decide how much you want to pay. Or you can choose, hey, I need X amount of coverage. Or how long I want that coverage in place for. So those are the 3 things we get to choose. You choose 2, they choose 1. So if you say, hey, listen, I want $100,000 of coverage, but I only want to pay X amount, well, they're going to choose the time frame that you get to keep that in play. Or if you say, hey, listen, I want a policy until 100 years old, but I only want to pay X amount, well, they're going to decide how much coverage you get. Does that make sense? In any of those 3 areas, right? So you choose 2, they choose 1. The policy owner has the option of converting it from whole life to term insurance based off of whatever you're needing, but that is all you need to know about adjustable life. On addition to that, it has cash value. It matures at 100, okay? All right. Now then I want you to go to a whole new page again. This is where life insurance can be kind of tricky, guys. We're going to talk about universal life insurance. So UL, universal life insurance. These are some of my favorite policies. I absolutely love universal life insurance. They are one of the greatest products ever invented by the devil. The devil invented this product. People are like, why don't you like universal life insurance? Because when you understand the reality of numbers, it's different, okay? So universal life insurance, I want you to write the word ART. What did ART stand for? Come on, we know this.
Annually renewable term.
Okay, perfect. So I want you to write the word annual renewable term plus cash value. This is the skeleton of this product, right? It's universal life insurance is annual renewable term, so the premium goes up every year. The cost of insurance is going to go up every year, plus it builds a savings account. So in universal life insurance policies, they say get this policy because it's flexible. You can change your premiums at any time, plus it's going to build a savings vehicle. So in a universal life policy, you have what is called a minimum premium, which is, they say, let's just say we have $100,000 of coverage, Ellie, and your minimum payment is $80 a month. That's your minimum payment. Then you have what is called your target premium. Now, since we know this premium is going to go up every year, they recommend that you have a target premium, which let's just say your target premium is $120 a month. So your minimum is $80, your target premium is $120. So we want you to add an additional $40 a month into your policy, month in, month out over the years, because we know the premiums at 20 years old is not going to be the same at 60 years old. Do you know why that is? Because the cost of insurance is not the same. Remember, the cost of insurance is going to go up every year, so your premium is going to go up every year. So now this is the absolute genius of insurance companies. Absolute genius. If your new premium minimum payment is $200 a month at 60 versus 80, you now have a difference of $120. They're going to send you a letter in the mail saying, hey, your new premium at 60 years old is $200. What happens if you can't make that payment? You're allowed to unmute yourself, guys. Come on.
Oh,
What's going to happen to that policy if you can't make the premium?
if you can make the premium and it has cash value, wouldn't grab it from the cash value?
Okay, you're onto something. So you said it's $200 a month. So it's going to eat all that cash value that you built up. Now, what happens to the cash value? What happens to the policy once it's eaten up all the savings? You still owe $200 a month. What happens if you can't afford $200 a month at that time now? What's going to happen to the policy if you can't pay the premiums?
Would it last?
Aha, it lapses.
Mm-hmm.
So all the premiums you paid into this thing, it is imploding on itself. And if you're listening to this and you are doubting what I'm telling you, go to YouTube and type in seniors universal life insurance. You'll see news stories upon news stories of these insurance policies imploding on themselves. Yeah, you'll see that these things are imploding on themselves like crazy. That's why these things are made by the devil. So we say, what the bold print giveth, the fine print taketh away. So let me share with you the component of life insurance, guys. So one more thing I want to add you to universal life insurance. You have option A. So right here, I want you to write option A or option 1 or option B or option 2. 1 and A go the same, B and 2 go the same. Depending on the question, sometimes they'll change it. Option A. Easy way for me to tell you this without going into extreme detail for you to just enough to pass this exam. When you see the word corridor, CORRIDOR, corridor. When you see that in the question, I want you to automatically choose option A as the answer. Don't think twice about it. Choose that the answer. That is the answer. The word corridor goes with option A. Now let me share with you option B. Option B is that if you pass away, the family would receive the life insurance and the cash value. I haven't even talked about the other stuff about whole life insurance, but in this example, the whole life policy, the family, the beneficiary would receive the life insurance plus the cash value. And that is all I need you to know about universal life insurance to pass this exam. There are some other nuances about universal life insurance that are in policies, but this exam is just testing your knowledge to pass the exam, okay? Now let's talk about variable. I want you to write that word variable, and I want you to write life insurance plus securities license. You must be licensed in life insurance and securities in order to sell this product. So when you are approaching someone with variable life insurance, this product is not for everybody. It is someone who's very risk adverse. They're okay with taking risk. And next to the word variable whole life insurance, I want you to write the word separate accounts. The reason we're going to put your money into a separate account is because the policy owner, remember, in whole life insurance, the insurance company is taking most of the risk and they're giving you a little percentage on your cash value. But in a whole life policy, variable life insurance policy, a portion of the premiums is going to go towards the whole life insurance, towards the cash value. The insurance company doesn't want any part of your investment vehicle. So they're going to say, hey, instead of keeping our money with you, we're going to put your money to a separate account. And whatever that account does, good for you. Now, the things about whole variable life insurance, I need you to know. So there is a fixed premium with this, okay? There is a fixed premium with whole life insurance. Or the premiums are not going to vary on this. Now, and there is a guaranteed minimum death benefit, okay? So these are the key components of variable life. Fixed premium, guaranteed minimum death benefit. The only thing that is not guaranteed is the cash value. The cash values account is not guaranteed because it's going to fluctuate based off the performance of the investment vehicle. Does that make sense? That is all you need to know about variable life insurance, variable whole life insurance. Now, here we go. Variable universal life insurance. If it didn't get any trickier with just universal life insurance or variable life, let's just throw these things together and call it a day. Again, this vehicle is not for everybody. Okay. So variable life insurance is a type of insurance product that combines the features of whole life with flexible premiums of universal and the investment component of variable life. So we're going to read through these to make sure that we don't miss it. So variable universal life insurance has flexible premium that can be increased, skipped, or decreased or skipped as long as there's enough premium to fund the death benefit. So do you remember in universal life insurance when I said there was a target premium?
Yes.
I missed a part in there. Universal life insurance has a component that you can skip a premium. So you can skip a payment. That doesn't mean you have the option to not pay them. They're just going to take it from your savings account or your cash value. So universal life or variable universal life, just make sure you put in there, there's a skip component to this. This, you can increase or decrease the amount of insurance at any time. And this policy does have cash value, cash withdrawals, and policy loans. So you can always borrow from this account at any time as long as there's money in there. Remember, anything variable, when you see the word variable, I want you to write the word no guaranteed return. Anything variable, there's nothing guaranteed about it. If anything is guaranteed, it's guaranteed to fluctuate. But the insurance company does not guarantee an interest rate in this account. Now I'm going to keep this very simple right here because I want you to create like a sidebar, something for variable. And I think this is going to come up here soon, but variable, because you're going to see something about variable annuities and variable life insurance. They're actually going to be coincide together when it comes to definitions that it'll help you remember everything. But variable life insurance, you need your life insurance plus your securities license. They are regulated, they must be registered with a company called FINRA. FINRA is a securities organization that monitors people with their licenses, okay? And you are also regulated by something called the Securities Exchange Commission, which is called the SEC. For you guys that are in my trainings that talk about FINRA, talk about the securities, that with your licenses. So just write FINRA, type in SEC, write in SEC next to your variable life insurance license. We're going to cover more in detail about that later. Let's talk about interest sensitive whole life. I actually need to read this. Interest sensitive whole life is also referred to current assumption life, a life insurance policy that provides a guaranteed death benefit at 100. The insurer sets an initial premium based on current assumptions about risk, interest, and expenses. If the actual values change, the company will lower or raise premiums as at designated intervals. In addition, interest-sensitive whole life policies credit the cash value with current interest rates and that are usually comparable to money market rates and can be higher than the guaranteed levels. The policy also provides a minimum guaranteed interest rate. Let's just sum that up. The premiums are guaranteed. The policy also provides minimum guaranteed interest rates. Okay. The death benefit is guaranteed at 100. Again, we already knew about that, about whole life insurance. The policy provides minimum guaranteed interest rates. Yeah, this is a standard whole life policy. They're just saying that the interest rate of the cash value, it's based off the market or whatever. It's generally a low bearing interest rate account. All right, let's talk about index life insurance. If you don't know what an index is, the index is it's attached to the stock market, okay? There's something called the S&P 500, which is the top 500 blue chip companies on the stock market. There's something called index funds, where they will they'll create a fund that mirrors the stock market, the top and public traded companies. Let's just read this and I'll try to simplify it for you. The main feature of a whole life insurance policy is the cash value is dependent upon the performance of equity, such as the S&P 500, that there is a guaranteed minimum interest rate. The policy's face amount annually increases to keep up with the pace of inflation, without requiring evidence of insurability. Index whole life policies are classified as depending on whether the policy owner assumes the inflation risk. If the policy owner assumes the risk, the premiums increase with the increase of the face amount. If the insurer assumes the risk, the premiums are level. Okay, let's just simplify that. Index whole life insurance. I want you to write this down. Write the word equity. The word equity is going to refer to ownership. And this policy, they're saying that if you are going to assume some of the risk, then you're going to assume some of the risk. If you're going to assume some of the risk or benefit of the investment vehicle, you're going to assume some of the risk when it comes to increasing your premiums. So next to equity, there's a guaranteed minimum interest rate. That's what we're looking for the key components of this. Guaranteed minimum interest rate. The face amount can go up based off of the accounts without proving anything. So anytime generally you would increase your coverage, you have to requalify medically. But in this account, if the account goes up, you don't have to requalify medically. What part you need me to repeat? Yep, so as a guaranteed minimum interest rate, the face amount can go up based off of the performance of the account to keep up with inflation. Give me an easy example of this. If you start off with a $100,000 life insurance policy today, we know in 10 years, $100,000 is not worth the same as it was then. So they will allow you to increase your coverage to keep up with inflation. So equivalent what $100,000 today is in 10 years, they're hoping to have the face amount equivalent to that. And you just don't have to requalify medically. Now, if you go up in coverage, there may or may not be an increase in premiums. Does that make sense? Do not try to overcomplicate that policy. What I gave you the key components, leave that alone. Joint life, first to die. Okay, we're going to simplify this. Okay. So next to joint life, right, first to die. This is when you combine two or more people's together in one policy, and they're going to pay out based off the first person dying. So let's just say you got grandma and grandpa. They got a joint life policy. Grandpa dies first, they're going to pay out. So the money goes to grandma. Now the premium is going to be based off of both of their ages. So it's common to find joint life policies issued on spouses. This is particularly so if the need of the insured that does not extend beyond the first life, the first death. So again, if a married couple passes away, let's just say you got old grandpa, grandma. If grandpa passes away, they want to have enough money to cover the mortgage, pay the house off. That makes sense? You can also have a joint life in a business deal. So I'm going to cover something in a little bit called buy-sell agreement. But this could be something used on business partners. Second, now the second one is called survivorship life. Second to die. This one is generally used for more legacy. This is more used for, hey, you know, grandma's really not going to need the money if something happens. We're going to leave this to the kids or to the grandkids. So again, they're going to take, the premium is going to be based off of a joint age. And they're going to say, okay, hey, grandma don't need the money, so we're going to take out a policy on both of us. So when both of us die, then the people will receive the money then. All you need to know about those policies. Any questions on this stuff so far? Am I going too fast for y'all? You said yes? Okay, perfect. No, she said I'm not going too fast. She's getting it all. All right, let me just check on here, see how much more we have to go. Oh, we're almost done. Perfect. Good, good, good. I want you to go to a whole new page, guys. Whole new page. Like I said, I know this chapter is heavy. All right, we got new pages. We're going to cover annuities. Annuities have absolutely nothing to do with whole life insurance. Sometimes we can get terminology that's going to be confusing in both of these, but we're going to simplify this. It may take you 1 or 2 times to listen to this audio and to read this for you to get it. But for the first time, I just want to explain it to you, okay? Annuities. Annuity is a contract. It is a life insurance. It's a life insurance company policy. It's used as a savings vehicle, but it's generally owned by an insurance company. So an annuity is a contract that provides income for someone's life down the road. Annuities are not life insurance, but it is an investment vehicle that is used to liquidate a person's an estate. So if you've ever heard of people winning the lottery and they say, hey, you won $1 million. And then, you know, after taxes. So if you take the money, a lump sum up front, they generally lose half the money, right? You've ever heard of that? And then they're taxed on that money. Well, the reason you lose half your money is because a lottery generally will put your money into an annuity. So let's just say you have $1 million and you say, hey, I don't want all the money now. Give me the money over 20 years. So you will get that money paid out over to you over 20 years. If you've ever heard that commercial, it's my money and I need it now. J.G. Wentworth, 877 cash now, 877 cash now. Guess what? That is an annuity company. They say, hey, if you have an annuity or if you have money, let us help you liquidate that over time. JG Wentworth, 877 cash now. 877 cash now. Or there's that peach tree. I remember those back in the day. So annuities. Who buys an annuity? Well, guess what? Generally, the person that buys an annuity is that they are putting money away that they want it to either be safe long-term, so they'll always receive money, or the beneficiary will always receive money. You don't have to write that down. I'm just kind of giving you the understanding of an annuity. Okay, let's talk about the parties of an annuity. You have the owner. The owner is the one that's paying for the policy. The owner does not have to be the one receiving the benefits, though. The owner has all the rights to the annuity. If the owner wanted to change the type of annuity, or cash the annuity out, or they want to change the beneficiary, they can do anything. So we got that. The next person is the annuitant. This is the person that's going to actually receive the benefits. So you know how like in life insurance, we have the policy owner and the insured?
Mhm.
The insured would be the annuitant. In this example-ish. The person's life expectancy that's taken into consideration is the annuitant. And on the exam or test, you'll say whose life expectancy is taken into consideration on when purchasing an annuity. Is it the annuitant?
Hmm.
Aha! I think Ellie just had a wake up call. A ding dong. Hey, I got that one right.
Yes.
The annuitant must be a natural person. You know, it's 2023. I don't know what a natural person is these days, if we want to be politically correct. What is a natural person? That's not true. And it must be a natural person, guys. That means it must be a human being, it must be an actual person receiving these results or receiving these benefits. Now, know this, because annuities are based on the life expectancy of the annuitant must be a natural person, regardless of who's paying for it. Okay. Now, who the beneficiary, the person who receives the assets, the amount of money, whichever is greater. If the annuitant dies during the accumulation period, the balance will go to the annuity's benefits paid out. Okay. Let's explain this. How does an annuity work? Well, an annuity, again, is just a savings vehicle. It's a savings vehicle the insurance company sells. So let's say, Tatiana, we're going to take you as the owner. You're going to be the owner and the annuitant. So you're going to be buying the annuity for yourself. You go to a company and say, hey, listen, I want an annuity. I want to put money into this month in, month out, or I just want to put a big lump sum up front. And when I'm ready to cash in, I want to receive money. So we have two ways. The accumulation, we have two ways of how we pay into this. I want you to draw a bar, like a bar down. So on the top of it, you're going to write accumulation period. And under accumulation period, I want you to write pay in period. These mean the exact same thing. And I saw you draw like a T-bar. That's what I want you to write. And on the other side, I want you to write annuity period. And below that, I want you to write payout period. So on the left side, you would have accumulation period, underneath that pay in period. And on the other side, you would have annuity period, payout period. And then underneath that, I want you to write annuitization period, this word right here. And then underneath that, I want you to write liquidation period. All these words mean the exact same thing if they're underneath each other. Accumulation period is the same thing as pay-in period. Annuity period is the same thing as annuitization period. It's the same thing as liquidation period, same thing as payout period. Why do they name all these different names? I don't know. But here we are. Ain't no getting around it. So let's at least understand this. The reason I'm taking my time and helping you understand this vocabulary is you're going to know this stuff so good. And no matter how they throw this question at you, upside down, backwards, say, no, ho, that ain't the answer. This ain't it. Okay, this is it. Bam, I got it. Okay. Now let's talk about the accumulation period. What is the accumulation period? This is when you're putting money into the annuity. Underneath that T-bar, I want you to write the frequency of how we're paying into it, okay? You're going to pay money into this two ways. You're going to put it into single premium or frequency payments. So you're going to do one lump sum, how you're paying into it, or frequency payments, which can be monthly payments, quarterly payments, or whenever I have extra money payments. Do you understand that? Now, during this accumulation period, I want you to know this. Your payments you're putting into this, the money you're growing, is going to be converted to called accumulation units. I like to refer to accumulation units as like shares in a company. Like if you were to take $100 and you say, I'm going to go buy $100 worth of ABC company. You have 100, whatever $100 would buy, number of shares. But you're buying accumulation units. That is what your money is converted to. During the accumulation period, your money is going to grow tax deferred. Your money is protected in this vehicle that taxes aren't paying into it. So it's going to grow into stuff. And when you start pulling out of it later in the life, you'll pay taxes on the growth then. So I want you to write money grows tax deferred. Money grows tax deferred. I also want you to write the money is taxed. You're going to say the money is taxed based off of last in, first out. The acronym for that is called LIFO. Last in, first out. So if you decided that you needed to pull money out of this, the last dollar in is the first dollar taxed. So last in, first out. Like if you've worked in the restaurant field, it's actually first in, first out. Hey, you make sure you rearrange your shelf of your items, right? You have to rotate your inventory. And an annuity, money's taxed in, last in, first out. So let's talk about the type of annuities. So I don't know how much space you have on your sheet of paper. If you need to go to a whole new sheet, go to a whole new sheet. I promise you I'm giving you all this, but I'm gonna bring it back together at the end of this, okay? There's only two types of annuities. And I want you to write a T-bar. I want you to write a T-bar. On the left side, I want you to write variable. And on the left side, I want you to write, on the right side, I want you to write. On the left side, I want you to write fixed. I got it backwards, guys. On the left side, I want you to write fixed. Right side, I want you to write variable. And I'm going to give you every detail of the word fixed, okay? I want you to write guaranteed interest rate. Yes, under fixed. Everything I'm going to give you right now is under fixed. guaranteed interest rate, must have your life insurance license to sell, general account, does not keep up with inflation, and then the last one you're going to write is suitable for the elderly. Suitable, SUITABLE. Why do I spell that out? Because I'm proud to know what suitable means. Suitable for the elderly. What does that mean? It means that it is safe, suitable for someone for their sake. Okay. Last one underneath that. Life insurance company takes the risk. Underneath that, underneath suitable, underneath suitable for elderly, you're going to create another bullet point. Life insurance company takes the risk. Because remember, this is a life insurance product. So variable and fixed are the complete opposite of each other. So if we can understand this, how this works, let's go to the right side. What was the first bullet point I gave you?
Guaranteed interest rate.
Guaranteed.
Okay, if this guaranteed interest rate is on fixed, what do you think variable is?
Not guaranteed.
Perfect, good, write that down, not guaranteed. Interest rates are not guaranteed. What was the second one?
Must have life insurance and
Perfect, so you must have your life insurance license. So for this one, you need your life insurance plus your securities license. If you remember me earlier in the chapter, I talked about the SEC. This is where that was going to come tie together. I want to break down this vocabulary for you so you can be like, man, I know this. So you need your life insurance license plus your securities license to sell anything variable. What was the next one?
general accounts.
Okay, over there, I want you to put separate account. The reason it's in a separate account is because in anything variable, the insurance company doesn't want to take the risk with you. So they're going to say, hey, we're going to keep our money in this general account. We'll take your little saving over there and you take the risk. Okay. What was the next one?
Doesn't keep up with inflation.
Aha. So what do you think variable does?
It keeps up.
Keeps up with inflation. What was the next one?
Suitable for elderly.
Suitable for the elderly, right?
Hmm.
This one is more suitable for younger people. You will probably never sell a variable annuity to somebody that's older. And the only way that you would sell a variable annuity to somebody is if they don't ever plan on using the money themselves. Because when the older you get, the less risk you need to take for your accounts. Because the market can fluctuate too much. And the last one was what?
The life insurance company takes the risk.
The life insurance company takes the risk. On the other side, you're going to put the annuitant takes the risk. You guys see how that's broken down?
Yeah.
Does this kind of help you understand fixed versus variable?
Mm-hmm.
Yes.
Perfect. All right, so let's talk about let me scroll through here. I'm just trying to. I'm gonna simplify this for you. Okay. So underneath that T-bar, you kind of create it, you fix it up yourself. Okay. That's all you need to know about fixed and variable. The next part about and the accumulation phase is how do you pay into it? You pay into an accumulation of a policy either through single premium or periodic premiums. You're either going to make one big payment, and when you see the word single premium, what word do you think you should write next to that? Think back to single.
Lump sum.
Boom, good, got it. Anytime you see the word single premium, think the word lump sum. The next word is periodic premiums. I want you to write the word flexible premiums with that though. Because you'll probably see the word flexible premiums more than periodic premiums. So flexible premiums, obviously, you know, you pay into it periodically. That's going to determine how you pay into it. Now let's talk about how you can receive the money, the time frame. How soon can you start pulling from this? During the annuitization phase, there's something called immediate annuity. So write immediate annuity. That is going to refer that you can get the money within less than a year. So if you have a single premium annuity, so you put in 100 grand and you say, hey, I want to start receiving money from this. Well, you can do it with less than a year. And then you have deferred annuity, which is after a year, okay? Make sure you understand the difference between immediate and deferred. Less than 1 year, deferred after 1 year. Now, when we do this, I want to talk to you about the very specific things here of how you can pay into it, and how soon you can receive it. If you have a single premium, I want you to write this down. Make sure you write this down. You can have a single premium immediate annuity. Write that down. Single premium immediate annuity. Underneath that, I want you to write single premium deferred annuity. What that is saying is you can put a big amount of money up front. You have the option to take it right now, or you have the option to defer it. That's the first option of how you can pay into it and how soon you can receive it. The second one is, so create a whole other bracket, whole other bullet point, because these don't go together. The next one is called flexible premium deferred annuity. Flexible premium deferred annuity. What that is saying, Tatiana, is, hey, I'm going to put in multiple payments and I'll get it later. You cannot have a flexible premium immediate annuity because it's less than a year and you've only put in so many payments. Does that make sense?
Okay, yeah.
Yes.
So we can have flexible, we can have single premium, immediate and deferred. We can have flexible premium deferred. We cannot have flexible premium immediate annuity. That's an easy answer for you to get right because you will see that on your exam. Which of the following of these is not this? And that's why it's so important for you to know each little vocabulary word of like, oh, I know how to break that down. I can look at that. Man, then I got to catch me on that. Because most of this exam is vocabulary. So let's go through here. I talked about fixed annuities. I already broke that down. I already talked about variable. Interest rate underlying investments. You're not going to come across most of that. Equity indexed annuity. Let's just give this to you very simple. When you see the word index, what was the word I want you to write next to that? Do you remember? If you don't remember, that's fine. I'll give it to you. When you see the word equity, I want you to, when you see the word indexed, look at the word equity. Like those coincide together. Anytime you see the word equity, I want you to think of the word ownership. Where it says a fixed annuity, where it has aggressive higher returns, I promise you, you're not going to be quizzed on that. You just need to know that this has a guaranteed minimum value. Everything in bold here, you need to know. Do you need to know why it means that way? Absolutely not. You're not going to get quizzed on this type of stuff. You're going to get quizzed on what is equity, which of the following annuities does this, has a guaranteed minimum current. Boom. Guaranteed minimum. I know it ain't fixed. I know it ain't variable. Let's go. Okay, bam. Let's go and index. And even if you don't remember every little thing about this, know a little bit, make it sound a little bit familiar, and you'll be able to guess your best way to this. Okay. Let me see this. Payout methods. I want you to write this on your paper on annuities, okay? Payout methods. You're going to look at payout options. You ready for this acronym? You're going to write the word settlement options next to it. Payout option, settlement options. And you're going to write the word cliff. C-L-I-F-F. Cliff. I sound like Rachel. Can you say this? Jay? Can you say cash? So C stands for cash. Cash payment. L stands for life income. Can you say life income? Okay. A stands for accumulation at interest. Accumulation at interest. You're not going to see that on your screen. Just write it down. Okay. C stands for cash. A stands for accumulation at interest. The first F stands for fixed income. And the last F stands for fixed. I said fixed income. Forgive me, guys. It stands for fixed amount and fixed period. So two F's, fixed amount, fixed period. I? Oh, snap. I was giving you guys a wrong acronym. There is no A in Cliff.
Exactly.
CL, interest only. Forgive me, guys. The Cliff, CLI stands for interest only. I'm getting ahead of myself.
Cash payment, life is amount.
Okay, so let me get it straight. Cliff is gonna be C cash, L life income, I interest only, fixed amount and fixed period.
Correct.
Okay.
Golly, people are gonna be watching this like, man, this guy don't know his stuff. And listen, I know enough to pass this thing. I've gotten hundreds of people licensed, so I know enough to help you guys out. And I promise you guys, that is all you need to know about insurance and whole life insurance, term insurance, and annuities. There's a whole bunch of other stuff in there that you can go back and read, but that is all you need to know about annuities, life insurance, and yeah. I know it's heavy. I know tonight was a heavy subject, but if you rewatch this and you listen to this and you play my sweet voice in your ear while you're running and you're jumping and you're swimming and you're running around with your kids and just say, man, this guy is so amazing. I don't have a Matthew McConaughey voice. I got a daggum, I can't wait to pass his exam. I'm done listening to him talk voice, which is why I talk the way I do. Anyways, so yeah, this is what we do. So for y'all that are listening and you made it to the end of this video, congratulations. We will continue part 3 on the next video. Make sure you follow me on Instagram at IamMiguelCamargo. Subscribe. You're getting all this value. You better subscribe. And have an amazing day, guys.